is the sort of PAT decline that has happened, which was largely on the anticipated lines?
Oh yes, so sequentially weak quarter is what we were expecting for JSW Steel, and that's how it has come out. In fact, margins have contracted by about 650 basis points on a sequential basis because of rise in input costs that the company witnessed this quarter. In fact, revenues have come in at 38,000 crores, a decline of 19% is what we've seen on a sequential basis, and volume-led destruction is the reason why top line has declined by as much as 19%. Margins have come in at 11.3%, a contraction of 600 basis points. By profit after tax has declined by as much as 74% on a sequential basis. Volumes were the key reasons. Export duty was imposed in the month of May, and that was the reasons volumes have declined by 22% on a sequential basis. They've come in at 4.03 million tons this quarter versus 5.11 million tons that the company had done in quarter 4 of FY22. In fact, as far as Capex plans are concerned for FY23, they've lowered their total capital expenditure from 20,000 crore rupees. They've reduced it to 15,000 crore rupees. In quarter 1, in fact, they spent around 3,700 crores on Capex. In fact, the company's average utilization levels also fell from 98% in the previous quarter to 93% this quarter, and this was because the company did undertake some shutdowns in this quarter because the situation was not intuitive to undertake the activities this quarter. In fact, the management has also in its presentation highlighted that export duty is a temporary measure, and they expect that perhaps it will be rolled back by the government anytime soon. We have two important brokerage notes that have come out in JSW Steel this morning. First up, CITI, which has maintained a neutral rating. They've increased the target price to 600 rupees per share. They say any positive news flow from China will be a key trigger for the stock going forward. Current valuation suggests that there is limited upside versus its peers. The stock, remember, trades at around 1.8 times price to book at the current valuation. In fact, JP Morgan has also maintained a neutral rating. They've given a target price of 610 rupees per share. They say margins should improve from quarter 3 onwards, and this is something that the management has also highlighted. They've reduced FY23 estimates on account of various guidance. So all in all, weak set of numbers, but more or less in line with what we were working with.